Hey guys, what's up? It's Diem,
And Hannah.
and we are back today talking about, I guess there's a Fed meeting or something like that.
Yes.
So I have to say, I'm not really super into the news about the interest rates. I really focus on homes. So, Hannah, can you tell us about what's going on?
Oh my goodness. Yes, DM. So huge Fed meeting. It just happened recently, literally the 17th and 18th of September. So extremely recent.
Yeah.
And it was a huge deal because we were anticipating that the Fed would do their first rate cut that they've done since the pandemic. So a couple years,
Wow.
literally, since they've done a rate cut.
Yeah.
The past couple years, we've only been seeing rate increases.
Right. We noticed that, right?
Yes, exactly, in order to help curb inflation.
Yeah.
And so, because of certain economic data that's been coming out recently, the market and mortgage companies and banks have been anticipating that there would be a rate cut at this Fed meeting, and it happened. And it was a 50 basis point cut, which is 0.5%. So it's large.
Wow.
Like a big rate cut. So yeah, big news.
So what does that mean for, I guess, home buyers going into the market or people who have existing loans where their rates are higher?
Yeah, so great question. Interestingly, rates did not drop after this meeting.
How can that be?
Right?
Or what does that mean?
Yes, exactly. So, and I can tell you, I mean, I have a lot of people who've been waiting for this meeting to happen.
Yeah.
Because everyone was hoping that after this meeting, rates would plummet. What ended up happening, though, and this is something that we've been prepping people for, that are clients and looking to refinance or buy, is that this cut was already priced into the market.
What does that mean?
Good question. So what it means is that specifically for mortgage rates, rates were already reduced ahead of this cut happening because there was such a high likelihood of this cut happening
Right.
and a 50 basis point cut happening that banks already adjusted their mortgage rates for it.
Okay.
And same thing in the market. The market has been trading as if this cut was going to happen.
Okay.
So we were anticipating one of two outcomes, pretty much. And these two had the highest likelihood of happening. One is that the Fed would be more positive with their economic outlook than what the market was even anticipating. And if that were the case, then they would potentially even do a bigger rate cut than they did, or promise that there would be future cuts happening and exactly when they would happen. The other outcome that we also knew was likely is that the Fed would do the rate cut, but then not promise what the next steps would be.
Okay.
And that's more in line with what ended up happening.
Okay.
And this is why rates did not drop further, because the Fed ended up pretty much doing exactly what the market thought it would do. And beyond that, Powell, the Fed chair, did state that we do anticipate there to be more rate cuts this year, and the same amount of cuts that they've been projecting for next year, which they're thinking once we get to the November meeting on through next year, there would potentially be 6 rate cuts between now and the end of 2025, which sounds amazing.
Right.
Right? Yeah.
But now I'm reluctant because, if they did in fact cut the rate, but since it had already been priced into the market, that means we as the people, the consumer of mortgages, aren't going to necessarily feel anything.
Exactly. And so with him, saying that this is the idea going forward, this is what the Fed board hopes will happen, he would not commit to it as a solid plan. And in fact, he even used language saying we're still going to be data dependent on if these cuts happen, and it's all going to depend on if the economic data continues to show slowing down in the economy.
Right.
And an example of this is that, literally this meeting happens, the next day rates actually ticked up because there was the initial jobless claim report that came out was lower than what the market anticipated. So it's still showing that the economy is strong. The job market is strong, right? So the outcome is not what people had hoped for, but it's exactly what the market had predicted, which is why there was no change. And then the next day, literally, again, because rates depend on what's going on in the economy, with that language from Powell followed by an initial jobless claims report showing there were less jobless claims than they thought. It was like, well, maybe we're not going to get as many cuts as we think.
Yeah.
You know, depending on what happens.
So thinking of it from like, just let's pull the buyer's perspective.
Yeah.
They're thinking, okay, early on in the year, they're thinking, well, reports say we should expect some decrease in interest rates further in the year. But we're actually not seeing that translate, because even though there were rate cuts, that had already been priced in.
Yes.
So this idea of waiting for that to happen before you jump into the market to look at homes for purchase hasn't served quite as advantageous as people had hoped.
Yes, unfortunately. And here's the thing, though. So, you know, people have been waiting for certain cuts to happen, right? For rates to go down. And they did. That's the thing. They did go down. But it happened before the meeting happened.
Right.
And so we saw this break and reduction in rates over the past couple of weeks. As the economic data has been coming out and as these reports have been coming out, rates have continued to drop. So rates have dropped. What, you know, people have said would happen is true.
Yeah.
But you also don't want to miss the opportunity, because it did happen.
Yeah.
And it's probably not going to happen further right now. It might happen further later in the year, but again, it's all going to depend really on how the economy is doing and what those economic reports that we're seeing tell us about the temperature of inflation, the jobs market, and consumer spending. You know, everything ties into what the Fed is going to be looking at when they're determining if it would be a good idea to cut further, or how big of a cut it would be, in order to try to keep the economy in a good position, instead of, you know, making inflation spike back up, or not doing a cut when would be appropriate and then dipping into a recession. So the Fed has done a very good job so far in keeping the economy strong, like determining when these cuts and increases would be appropriate for the economy. And, you know, the economy is still really strong because of how they've decided to do these cuts and increases.
So then let's talk about it from the perspective of someone who's purchased a home in the recent years. At what point, because they were also waiting to refinance potentially into a lower interest rate, what do we do from here? So,
great question, because this is really a huge number of people who I think were waiting for this meeting. You know, again, this is where you have to be really careful about trying to time the market. Because this is a great example of how that can backfire a little bit, right? So we had those cuts happen. We had in the mortgage rates, not by the Fed yet, but we had that drop in mortgage rates already ahead of the Fed's decision, because they were so confident that's what's going to happen. So at that moment, that probably would have been the best moment to lock in that rate and refi. Now that meeting is over. Rates have not changed significantly because they did exactly what was anticipated. It wasn't better. It was technically a tiny bit worse because of his language around being very data dependent. So what I'm advising clients right now to do, and you know, you have to do what's good for your situation, but I think it's always going to be beneficial to be looking at your scenario and seeing what's available to you. And if you're happy with the monthly savings that you can get right now in a refinance, and the cost is minimal, or maybe even it can be wrapped into your loan with no out-of-pocket cost, and it's going to save you a couple $100s a month guaranteed, it's like, that's probably something to consider right now, because most likely rates are not going to have a huge drop from here. And if it looks like the Fed's going to do another cut in November, we're going to price that in ahead of time too, unless they do something dramatic that would be unplanned. And over the past couple years, everyone, just, and as a reminder for myself too, right? They've been so on track with whatever they've said, where it's like they have not surprised anybody at all. They've been very data dependent and have just taken this slow and steady approach. And I'd be really surprised if they, leave that type of behavior.
Yeah.
Because they've been so consistent in it.
So when I think about if I'm going to make a financial decision to cut some kind of a cost, I typically take the monthly savings, times it by 12, and I can see what that equates to in a year.
Yes.
And even furthermore, like I remember when I was trying to remove my mortgage insurance, I think, because that, for conventional loans, they don't stay forever. So I thought, okay, if I was going to pay for an appraisal, I wanted to offset that cost with how much I could save for this year, each month, each year, and then for the life of that, however long it was going to stay on for.
Yeah.
So is that the right way to think about interest and refinancing, or like how would you say?
So that's how I do it with clients. We look at the cost of the refinance,
right,
and then we take the monthly savings and we divide those numbers and we see how long it would take you to make back the cost of the refinance.
Yeah.
Even if you wrap it into your loan, which is no out-of-pocket cost. This calculation doesn't even take into account appreciation though.
Yeah.
So in my mind, if you're able to pay off that refinance cost that you didn't even pay out of pocket for, with the monthly savings within a 2-year span, usually it's going to be a pretty safe decision. And I use the word safe because it means that you'll now be reaping benefits above and beyond whatever you invested to make those savings. And it also, there's usually not a very large amount of change that happens in a stable economy within a year or two. So most likely by the end of those 2 years, you might be in a better position to refinance again, but probably not. Like probably you're going to be in a spot where you want to keep hanging out for a while. Yeah. Now, this climate is very interesting because in a year, there might be an increased opportunity to refinance again. So what I'm showing clients and what we're looking at for numbers is, well, can you make that cost back in a year? Because if you can, I mean, that's an incredible deal. No brainer. First off, it's just kind of like absolutely no brainer, but it's also, you make that cost back, and then if you have the opportunity to refinance again, great. But if you don't, you've already made that back in 12 months. So, and I think there are quite a few people who can do that right now because they have a higher interest rate. And we're locking that rate and purchasing a home last year. And so there is a lot of opportunity in the market for certain people to be able to make a really good savings and offset that cost in a very short amount of time. But it all depends on your specific situation. Right, of course. That's where it's really important to talk to your mortgage advisor, talk to the people who can help you do this and see if it really would be beneficial.
So, like sometimes I've had new home buyers call me and ask me questions that make me think they are potentially uncertain or feel skeptical of consulting with their mortgage person. Not a particular mortgage person, but in general, because their business comes from transactions, right? Okay. So what questions would I ask my mortgage advisor to know for sure that I'm being guided towards making the right financial decision as opposed to just another transaction for them? Right.
Yes. Okay. So, and let me clarify, make sure this is correct what I'm hearing, that sometimes it can feel like a mortgage advisor is just going to give you advice because they're going to make a commission. Right? Yeah. On that transaction.
Yeah. And how do you know, or what should you be asking to know that it's going to actually serve in your benefit?
Yes. The math numbers usually don't lie unless you're using false numbers.
Right.
So this is where it's really important to not just look at the monthly savings. And this is, I think, where it can get tricky for people. And this is why, maybe someone refinances before would actually be beneficial. As you look at that monthly savings and you're like, oh, I could save $300 a month. Let's do it. But then at the end of the day, you added $9,000 to your loan amount, and that's going to take you 5 years to make back that monthly savings, right? Or whatever it is, because the cost. So it is important to look at the math, and the general rule of thumb is that if you can refinance into an interest rate that's at least 1% lower than your current rate, it's probably going to be a good financial decision. Where this can have some swaying room is depending on your loan amount too, because the larger your loan amount and the higher interest you're paying, the more money you're really spending towards that interest, and the more potential savings you have available.
So even something that's lower than 1%, but a higher dollar value on a home, is going to still mean a lot of money.
Yes, and so that's where, depending on your situation, maybe it could be beneficial to refinance into a rate that's not that whole percent lower.
Good point.
But it's going to give you so much of a monthly savings that it could totally be worth it. And conversely, it's the same if you have a very small loan. It's like, well, maybe you need more than 1% to really make that savings work out.
And I want to touch on too, like what to do with that money. Like if you do move forward with a refi, but you've been able to pay your monthly payments and demonstrated to yourself and your family members that we can live off of a mortgage payment that was that high, the savings, maybe you don't just then keep, right? Maybe you invest that, because that would be an opportunity cost if you didn't refinance. So if you were able to take out a few $100s a month, could that now be invested into index funds, or even if you hold it high yield savings accounts, or what can you do with that money to make sure that it's actually serving your family even better?
Absolutely. And if you want to keep it simple, you could even reinvest it back into the principal balance of your mortgage and make the same payment, but you'll have a significantly higher amount going to principal, which then over time has you paying less interest. And if you're in a higher interest rate, where I caveat that with rates that we see today are not high. They are historically in kind of a median area. They're not, rates before have been like 20%. So
insane.
It's not so bad. But compared to 3%, which we were used to for a couple of years, which was also unusual, they do feel very high, because that's literally double. So with that being said, though, when you're in a large loan and you're paying 6-7% interest, that's still a ton of interest on a very large loan amount. So like you're saying, if you can afford that mortgage payment and you want to pay less interest over time too, and who knows where rates are going to be in the future. I mean, the Fed is hoping that they can get their federal funds rate to around like the 3% area, which would probably then take mortgage rates to around the 5s. Like maybe high 4s, low 5s for most people. But who knows what can happen. Things are very unpredictable and pretty volatile in the economy with all of that, just because the economy is so strong. So who knows when all of those cuts might actually happen. So yeah, if you're paying 6-7% long term on a mortgage, why not save some of that too and cut down the principal a little?
The other part I think about like saving money now is that it's in today's dollars. Like you could actually do something with it. And although typically if you're going to refinance, your intention is that you're going to keep this house for a while, you're doing these steps to do that. But life does change. And a lot of people who go into buying a home think that they're going to live there for a really long time, but end up being there less than 7 years before they make a switch. So it's like, if you can save on today's dollar and reinvest that or do something with it, even if it's to pay down the principal, and over time your home's appreciation goes up, you sell it and you get that back, right? It's allowing you to do something today, because you may or may not be staying in this home as long as you think that you will. And
that just goes back to, I feel like, the whole message here, which is like, the only decisions you really can make concretely are with what you have in the present. You can't go to the past and redo something. Then you can't project you can't predict at all what's going to happen in the future. You might have a projection, but who knows if that is going to be what happens.
Yeah.
So we really only have our present situation to go off of.
Yeah. So like saying that, oh, well, I should have bought a house in 2021, right? Or I'm going to wait until, the rates go down to this much, is not necessarily the parameter that I would personally use. It's more like, what does it cost me today? In today's rates, today's pricing, can I make that work? And then what are the benefits of home ownership over time? And do I want those benefits for myself? And the answer might still be no, especially people who have like particularly cheap housing opportunities, like landlords who are just so gracious and haven't raised rents over a long time. And you can still continue to save a lot of money every month. Maybe that's not going to apply to you. But if home ownership is something that you're striving for, then it is really more realistic to use what's happening right now in this moment as a gauge, and your means to be adaptable to that as a gauge, as opposed to looking at the past or the future.
Yes. And the only way, I feel like, at least for myself, the only way to not repeat that, well, I wish I bought in 2020, or I wish I bought in 2015, or, whatever it is to make the different decision in the present, right? Is to not repeat that. And I know, I even thought that with my second home, like, I wish we bought our second home in 2021 and, took that opportunity that was there. And, I could have just kept sulking about it, but instead I'm like, okay, well, let's get into something now.
Yeah.
And I know that's going to be the right decision. And so I think, just as you're saying, I couldn't have said it better.
Yeah.
No.
Very good. Well, anything else you want to share with us about that meeting or what's coming up next? Like, when are we expecting to see things change again?
So I think, well, let me give an overview of what Chair Powell has expressed as the vision going forward. And that is that there are potentially 2 more rate cuts that could happen by the end of this year. And they are assuming right now that both of those together would equal another 50 basis points. So that would take their rate down another 0.5%. So right now the rate is going to be, we're looking at a 4.5% to a 5% right now for the federal funds rate. So if they do reduce it by another 0.5% by the end of the year, then we're looking at a 4 to 4.5%. And then the plan from there is to do 4 rate cuts every quarter in 2025.
1 per quarter.
1 per quarter and 0.25%. So by the end of 2025, the federal funds rate would be somewhere between like a 3 and 3.5% ish, right? And there's this range, right? So it's not going to be perfect. The Fed has a range for their rate. It's not like it's just 5%. It's like it was 5.25 to 5.5, and now we're really looking at that 4 3/4 to 5, and then it just continues to go down from there. So by the end of 2025, though, we should be somewhere around like that 3-ish, 3.5%, if they do what they're saying they're going to hope to do. And I use that language because he was so clear in his press conference that this is not an actual confirmed plan. And something to take note of is that this decision to actually cut their rate by 50 basis points, which is 0.5%, was a decision that was not unanimous. So there was one board member who said, no, we should not cut rates by that much. And that has not happened in almost 20 years. Having a split decision like that on something like this. So I think that's also important to keep in mind with how sensitive this situation could be, right? So that is what they are hoping could happen if the economy still shows that inflation is slowing at the rate it is and is still maintaining strength in all these other sectors. They're hoping by the end of 2025, their rates can be somewhere between that 3 and 3.5% area. So that is the hope, right? Now, something that is good to keep in mind is that there's a huge election coming up. And, this election cycle, specifically because of the political environment we're in, already makes the situation more volatile. And then, add these rate cuts on top of that, and everyone being worried about inflation and all these things, and the economy is still doing well. And that's the sticky thing here, is the economy is still doing well. So there's not like an emergency happening in the economy.
Right.
So I think it's important to keep in mind that we have this huge election coming up, which could also throw a big wrench into any of these plans, depending on how the economy responds after the election. And something else to keep in mind, I know there's all these things to keep in mind, but something else to keep in mind is that after the election, that president does not take office until the end of January. So, it's easy to think about, after November, things are just going to be how they're going to be.
Yeah.
It doesn't work that way, right? They're not even going to be in office until the end of January. So there's a lot of things that are going to be happening. And that's why it's really important to stay updated.
Yeah.
So we're going to keep everyone updated. There's lots of sources to stay updated, but it's important to be aware of what's going on and then, evaluate your own specific situation.
Yeah. And just like we talk about refinancing now for people who are already in loans at higher interest rates, when you look at your home purchasing decision, the next one or the first one, the same concept will still apply.
Yeah.
So as long as you feel comfortable with the mortgage payment that you would be walking into, and that's a fixed rate, then you just stay on that level until it is time to refinance you into a lower rate. And capture those savings.
Exactly.
So it's like wherever you enter the market, the main point is that just make sure it's comfortable for you and your current financial situation at that time, but there's no way to tell the future. So if the rates go up, you're going to be able to stay where you're at. If the rates go down far enough, you're going to be able to take advantage of that.
Exactly. Which is one of the biggest benefits of home ownership.
Yeah.
Is being able to take advantage of those market swings as they happen, right? Or to have a hedge against inflation. If rates do go up, then like Diem said, you're in a fixed rate that's not affected by that. But then if on the positive side rates go down, most of the time you can refinance.
Yeah.
So it's just great. The sooner you can, get into an investment that works for you and that's comfortable, usually there's a lot of benefits.
Yeah. I think that's it from us today, unless you have anything else. I'd love to get your guys' feedback. Today we did a little bit of a different thing, right? We usually talk about our own experiences, and today it was just more fact and data driven. If you'd like to hear more of that, let us know in the comments below. And otherwise, we will see you in the next one.
Bye.